All right. Then we look at gold. Gold is moving. Uh, we need to know where this thing is going, how far this thing is going to go. Are we in a B wave, which are traps, longer term? Um, but where can we find trades inside of this current market that we are in? I wanted to first start with some research to know exactly where we are, because there are some headlines that recently happened that is affecting the gold market, and that's going to determine what the gold market is going to do in the near term. So I threw some questions into AI, into Gemini, to figure out, what's going on, uh, to break down what the intervention by the Treasury Department has on the gold market. So I'm just go through what I did. So question question I posed is, considering the recent intervention by the U.S. Treasury Department into the bond market, I need one, a summary of what they did, what effects it has on the bond market. Is this similar to a stimulus, i.e., money printing, or a reorganization of debt? Two, what was the market response to this intervention? What are experts saying? And what was the actual response in bond market rates? Was the response in rates what the Treasury Department wanted, or did the opposite happen? Provide charts, graphs, and articles for proof. Number three is, what effects will this intervention have on inflation? Four, how should the gold market uh, respond? My thought is the recent intervention will cause more inflation along with inflation due to rising oil prices, and we see a rally in gold prices. So the summary, what the Treasury Department did and how it works. The U.S. Treasury Department intervened in the government debt market by unexpectedly doubling its liquidity, supporting buyback programs from longer term bonds, the 10 to 20 year and the 20 to 30 year. Uh, they increased it from 2 billion to at least 4 billion per operation. And that, I think they do that operation either weekly, quarterly. I forgot exactly how often they buy back bonds, which is basically government debt. And this stimulus money, is this stimulus slash money printing, or is it debt reorganization? It is a debt reorganization and duration swap mechanism, not central bank money printing. And here's the difference. Quantitative easing, which is done by the Federal Reserve, they're the ones that actually print the money. The Federal Reserve creates brand new digital bank reserves out of thin air to buy bonds from banks, expanding the total money supply in the banking system. What the Treasury Department did, Treasury buybacks. The Treasury does not create money. To buy back these older, longer term bonds, often called off the run debt, the Treasury funds the purchase by issuing shorter term debt, principally short term debt called T bills, Treasury bills. So in plain English, uh, think of it as a homeowner refinancing a 30-year fixed rate mortgage into revolving line of credit or credit card debt. Damn. The total debt hasn't disappeared, nor did the bank give them free money. The maturity profile was simply shifted to the front end to relieve immediate pressure on long-term rates. So the backdrop to this is Donald Trump, the U.S. government, they want interest rates to go down. he just put in a new Fed chairman, and he specifically wanted that chairman to start lowering rates. Well, the Fed chairman that he just appointed is not lowering rates. He's still on the, wait and see. Let's see what the market does. Okay. Which that's not making Trump happy. So it looks like what he did was he told Scott Bessent, who was the Treasury Secretary, looked like he told him to do something to try to bring rates down. Okay. That's what that intervention that they that's what the intervention was by the Treasury Department last week, right? They shifted debt around. And from what this is saying, they basically moved the 30-year fixed mortgage. They moved that debt into basically like revolving line of credit. So the T-bills that they're talking about, that is short-term government debt. So if you were to buy a T-bill or bonds as far as like an investor, you're basically giving the government a short-term loan because you're getting that interest right now, right? You're recouping the interest back on that loan that you gave them sooner rather than later. The later would be the 10 to 20 or the 20 to 30-year bonds. Okay. So they just shifted debt forward. Uh, so that's what they did here. So plain English, 30-year fixed mortgage converted into revolving credit card debt. Total debt hasn't disappeared, nor did the bank give them free money. The maturity profile was simply shifted to the front end to relieve immediate pressure on long-term rates. The market response, expert reactions, and yield dynamics. The initial response was a brief drop when the Treasury announced the buyback expansion bond. When the Treasury announced the buyback expansion, bond yields tumbled. The benchmark 30-year immediately fell roughly 10 basis points from 5.3% to 5.19%. The US dollar softened and equity saw a brief rally. So that brief rally was in I'll go over here. That rally was in um, Bitcoin, um, the gold market rally, something else rally. But he said equities, but hold on a second. Where's my back at? Equity saw a brief rally. Secondary response, the rebound. Within 24 to 48 hours, long-term yields snapped back towards the recent highs. Bond investors recognize that $4 billion per operation is a tiny drop in the ocean compared to the massive volume of new debt issuance into the market. Uh, that goes along with the headline of that America has hit the $40 trillion in debt mark. All right. Bond market yield dynamics. Pre-announcement 30-year yields hit 20-year highs at 5.3. The announcement yields dropped 10 basis points down to 5.2. 1 to 2 days later, yields are right back up, which this is the opposite response of what the Treasury Department wanted. They wanted those yields to keep going down. What analysts and economics what analysts and economists are saying. This was a band-aid on structural deficit. Macro strategists noted that buybacks are primarily a signaling tool rather than a fundamental cure. The Treasury put soft. The Treasury put and soft. Okay, so it's basically like a put. They basically are shorting the market again. Same thing that they're doing with the oil market. Analysts noted that by attempting to cap long-term yields via short-term issuance, the Treasury is attempting to manage borrowing costs without direct Fed quantitative easing, shifting market stress into currency valuation. It's destroying the dollar because you can see over here the dollar is going down. The dollar's going down. This also has to do with the yen. Let's see what the yen looks like. Currency right here. Let's see what the yen looks like. This is the monthly chart. Let me go down to the daily. That's what I should have did. Okay. So dollar is falling versus the yen right here. Okay. This definitely, just looking at this pattern right here, this is definitely, you're definitely going to get some continuation pattern back down. All right. This thing may go up a little bit more, but you're definitely going to get at least one more move down. Uh, at least one more move down. This is USD JPY. Then I want to go to the dollar. So this is the dollar on the daily chart. Um, the Fed announcement was last week. So one, two. So yeah, this is right here. This day, August 19th. Okay, so this is what we see in the charts. All right. So effects on inflation. The intervention introduces subtle upward pressure on inflation via financial conditions and money markets. Monetary friction, the mechanism, replace locked up long-term bonds with high liquidity T-bills. The inflationary impact, slightly expansionary. T-bills act as near cash equivalent for institutional investors and money market funds. And actually, Fidelity in their high yield account, they also buy short-term bonds because that's how they pay their dividends back to their customers that put their money into that high yield savings account. Financial conditions, caps mortgage rates and corporate yields from rising to their natural market clearing levels. Okay, this is important right here. Inflation impacts. The pro-growth of inflationary prevents the full restrictive cooling effect of high interest rates on credit demand. So that's basically saying that they're trying to lower that longer term interest rate because that's going to uh, keep mortgage rates from going higher, credit card rates from going higher, and the government, the interest that the government has to pay on that long-term debt, right? Because like right now, the amount of interest that we pay on the debt is higher than the amount of money that we pay um, for defense spending. So we're paying trillions of dollars just in interest. All right, currency weakness. Signals that the government will suppress bond yields rather than absorb high debt servicing costs. That's what that is right there, the interest on the government debt. Imported inflation. This also puts downward pressure on the US dollar, making imported commodities more expensive. So inflation, so the shit that we get from China and all those South Central countries down there, that's going to make that food, those imports, more expensive. Combined with sustained supply side energy friction, elevated crude oil prices, this intervention makes headline and core inflation stickier, complicating central bank disinflation targets. How the gold market responds. Your intuition is aligned with traditional macro asset dynamics. Gold tends to rally in this type of environment. Treasury, so here's the flow chart. Treasury caps the bond yields, leads to sticky rising inflation, which has effect on the real yields fall. Dollar weakens, gold rallies. So compressed real yields. Gold generates zero nominal yields. Its biggest headwind is high. Its biggest headwind is high real inflation adjusted interest rates. When the Treasury suppresses nominal yields while inflation runs hot, real yields decline, removing the opportunity cost and holding physical bullion. Currency debasement hedge. When market participants sense that the fiscal authority is intervening to keep borrowing costs officially low, capital shifts towards hard assets with no counterparty risk, which is gold, silver, and real assets. Geopolitical and commodity compounding. High oil prices feed consumer price expectations, accelerating the flight towards precious metal and core portfolio hedge. Okay, so that's a brief background to what just happened, all right, and why gold is starting to rally. So now let's look at the charts. So we're gonna look at gold, right? We're gonna look at some trade setups. Okay, how should we attack this new rally? Because you remember, we still have to look and deal with the whole chart, right? From beginning to end, from beginning to where we are now, right? So this is gold, and this price record goes all the way back to 1833. Okay. So there's a long history with gold. We're not going to get into that right now, but we do have to have some idea of where we are on the chart. And right now, big picture thinking or looking, we are right now in a grand supercycle wave 3, which long term is extremely bullish, right? We have a lot more room to go. Grand supercycle. Now, again, degrees. Grand supercycle, that puts you on, that has a time frame of centuries. Okay. Obviously, if this chart goes back to 1833 and here, right here in 1980, that was the top of Grand Supercycle 1. So then it declined all the way into 2001. Okay. That was the last real low. That gave us our Grand Supercycle 2. So between 1980 and 2001, that was a 20-year correction, correcting price action dating back to 1837, 1833, something like that. Okay. So from that Great Recession, the global financial, uh, what do they call that? The GFC, global financial crisis. All right. We have been in a rally ever since. Now, those corrections that we've had, um, we're going to have long-term corrections like this last one from 2011, August 2011 down to December 2015. That was a 4-year correction at super cycle degree. Okay. And there was a wave 2. It was a wave 2 of super cycle degree. All right. So now from that, um, 2000, December 2015, January 2016. From 2016, we've been on the last rally. Not the last rally, but the latest rally. So that is 16 to 26, 10 years. Okay. We've been on a 10-year rally. So where are we in this latest rally? There are we have two different counts. Okay. Um, the most bullish count is that we are still working to complete cycle degree wave 1. And so how this works as far as degrees go is your grand super cycle. That's the big daddy, right? That's the granddaddy. Then you have super cycle, right? So grand super cycle will get you, let me get it. So grand super cycle can last multi-decades to centuries. Uh, centuries. Sorry, my bad. So Grand Supercycle can last centuries. Then up under that, you have Supercycle. That can last multi-decades, right? 10 plus years, 10 plus years. Then under that, you have Cycle, right? Cycle can get you, 2 to 5 years, um, even, 10 plus. Okay. There's no hard, fast time frame. No, there's no hard, fast rule. Uh, obviously, the chart pattern dictates the ultimate time, but this is a rough guideline of what to expect when you come to uh, when we come to talking about degrees. All right. So uh, from here, we did the finish Super Cycle 1, Super Cycle 2, and now we need five waves up to complete cycle degree 1. So where we are now, there's two different interpretations. I'm gonna look at the most bullish interpretation right now is that cycle degree 1 is not finished, right? This latest pullback could be your primary degree, wave 4, and then now we have another uh, fifth wave to head up to complete cycle 1. Right, that's the most bullish count. Um, so even if this is your primary degree wave 4, we still have the potential that this is still going to be an A, B, C, right? To complete this 4 and then head up into 5, 1, then boom, then we'll be headed into a cycle degree 2, right? Which, as we just talked about, it can last several years, all right? Going sideways down. All right. So when we come back, we look at this chart. So if we look in that primary degree, which is the circle, uh, 1, wait, 2, then you have a lower, then you have this as 3 and 4, right? So then this is 1 and 2 intermediate degree 3 and 4, and then in commodities, as we talked about in the oil market, commodities will have a extended fifth wave. Your third wave is more roughly equal to the size of wave 1. All right. So this could be either primary degree. The more bearish count would be this was primary degree 1, 2, and then this is primary degree 4. I mean 3 and 4, and then this was primary degree 5, which completed cycle degree wave 1, and now we're going into a multi-year correction, right? So that's the more bearish count. So then that would mean that this move down and up is just the first move. It's just the beginning, that we're in the beginning of a downward move. So this if I pull up real quick, if I pull up the moving averages, okay. So this is the 8 and the 21. We've already dipped in here. We call this the Pima trigger zone, right? And then we see as soon as we got in there, we do get a bounce. So how far will this bounce take us? Do we have more room to go higher? Or is it just a little bounce before it ultimately rolls over? Okay, that's what we're getting ready to figure out. But here's the moving averages. Okay, we still are above the 100 and the 250. Okay, we're starting to try to flatten out and curl over, but Don't know this yet. All right. Uh, strong RSI at the top. Um, really, we do have divergence. Now, this is going all the way back though, like from the last high of 1968. All right, there is some kind of divergence there. All right. And then what we're gonna do is I'm gonna see what actually happened in 1968 at this time, right here at that peak. Oops, sorry. Oh, oh, okay. That's when Nixon. That's right around the time when they lifted the cap on gold, when they basically um, depegged the U.S. dollar to actual gold prices. Um, all right, I'm gonna leave that right now. So monthly chart, if we come back over here, RSI was still strong. We don't see any real recent divergence. Now we probably see that when I break down to the weekly and the daily chart. But here's the most important thing on the monthly chart is the MACD crossover, right? So at the every time your average lines in the MACD, every time we get a significant crossover of the signal line to the baseline, we have seen um, cycle level degree corrections, right? So we had crossover here, here, we had one here, and then what I want to do, okay, yeah, crossover there. What I want to do is I'm gonna go back in time. Then we're going to see the type of what the corrections look like. This is going to just give us another baseline of what we can expect. Okay, so that's the MACD monthly chart. All right, so coming back here, first one, we were in a correction. Oh, that super cycle degree, 7,000 days. I'm gonna calculate that. I wish they would put that in actual years too. So 7,799 divided by 365, 21 years. All right. Let's see. Let's see. The next one we had a crossover right here. This looks like a shorter one. That was 212 days, not even a whole year. Then we had this one right here. This one got us 1,552 days. All right. How many years is that? No, up there. What did I say? 1,551 divided by 365. The hell number is that? 4.2 years. That was here. That was that was your super cycle degree wave two. Right now we got over here. We had a correction lasting 820 days. That's easy. That's a little bit less than 3 years. I can figure that one out. So then now what degree, what type of correction will we see here? Now these corrections end up, depending on what degree you're in, you're going to need time to match up when it comes to these corrections. All right. So if this is where we are now, trying to complete cycle degree one, right? This is all one impulsive move. So which correction is it? The primary, this is wave two, of primary degree. It could be. It could. Okay. So if this is wave 1 and 2, we only had how many days is that? I can't see that. 120 days. Okay, 120 days of a correction. So now if we want this to be a primary, primary degree wave 4, we could be at the end of that. All right. So we're longer than 2 as far as time wise go. Okay. Your fourth wave is usually lasts longer than the second wave. Okay. So for the bullish count, this is what we want. If we want price to continue higher into a fifth wave, which could be an extended fifth wave. Well, maybe I don't know just yet. I don't know how far it's gonna go just yet. We'll come up with different numbers because this primary wave 3 is definitely extended. Right, that's 1 and 2 and 3. That's definitely an extended wave 3. Okay, without any doubt. Just quick thought though, just by the way it looks, right? This is one primary. This probably should be primary 3, but you never know. So you have to account for all the different variables. All right, so we're gonna rock with this right now. We're gonna rock with uh primary degree wave 4 is done. Okay, but also keep in mind that this is a major crossover. Now that does not mean that. Let me just delete this right quick. Delete all of it. That does not mean that with this break, we can still have this break and then we can still rally, right? We can still hit all a new highs, right? And then this signal line can still roll over again. And then now we have a higher high, a lower high divergence. Same thing on the RSI, right? We had our high here, right? High there, pull back, and then we can get another high in price and still get divergence in the RSI. All right, so that's the backdrop. That's what we need to be aware of. So we're going to shoot at minimum to get back to the recent highs, all-time highs. So then let's drop down to the weekly chart. So we don't have any divergence here on the RSI yet. Low, lower low, low, lower low. The MACD looks like it's getting stronger, right? Now we have starting to get the bright green bars that's showing uh, strong momentum. We do have a signal line crossover on the MACD and sharply heading higher. And our stochastics, same thing. We're working on the change of direction on the 60. We've got the 13 crossing over. The 5 is already up, oversold, right? So that's strong. That's a strong move. As far as the 60 being right in the 60s, right at the 50 right now, but the week has closed. So technically we are above the 50. Uh, we don't know what this coming up week is gonna look like, but when we get to the patterns, the impulse that we are in is still looking strong. So by the end of next week, we definitely will have a change of direction on the 60. No divergence though. Here's the 13, the 5. We might have divergence on the 5. I do like that. Hold on, let me mark. We do have, looks like some divergence on the 5. Yeah, we do. So, divergence. So the weekly So the weekly chart, we have some type of divergence. Okay, put that on this and on divergence there. All right, let's look at the moving averages. Okay, so we hit, excuse me, we hit the 100. Um, now we're bouncing. Now we're back above the PIMAs. We're back above the 8 and the 21. This is bullish, right? I mean, you can almost think about this like a trampoline, right? Trampoline, bouncing off of it. And then now, especially if we get another week higher, now that 8 and that 21 is going to start to separate and widen. And then if that happens, any pullback into that zone is going to be bought again to rally higher. All right. That looks, that's bullish. That's bullish. So let's start with, let's just say, wave 4 is over. 1, 2, 3. That is a 3-wave X, and then we can call that a 5. So you can call that a flat, even though we didn't get a deep retracement on that B wave. They came back to the 50. It did come back to the 50, almost a 618. So this is how we're gonna label it. We're gonna label this as a 335 or an ABC, and this will be at uh, intermediate degree. Call that A, call that B, and then call that C. C, let me see. I'm gonna put this in correction. P, wave 4, primary degree, wave 4, correction. And this is wave 4 is still in the cycle degree, wave 1 is still in progress folder. Okay. Uh, 3, 4. So now let me go ahead and just drop down to the daily chart. Let me turn these PIMAs off. All right. So this is your A wave down. This is going to be an ABC. That looks like this whole day chart looks like a real nice zigzag. Or maybe that can be, that looks like 3 waves right there on the daily chart. I have to go a little bit further down. Let me just go ahead and put an ABC. This would be minor degree. ABC equals A. And then that B wave, that looks like a WXY, a double zigzag is what that looks like. And that's going to be a minor degree. I could be wrong. We'll figure it out. We'll figure more out when we dive down to the lower time. So this is an ABC, then this should be a 5-wave pattern. And that looks like a 5-wave pattern. And that'll be a minor degree. This looks like 1, wave 2, wave 3, 4, and now 5. Okay, that is a good sign for the bullish interpretation. Just to make sure though, this 5 waves meets all the rules. So the 4 doesn't go back into wave 1 territory, which it doesn't. That's the main thing. Wave 4 doesn't go back into 1. Clearly 3 is longer than 1. and 5 is longer than, it's shorter than 3. Just to play around. Throw some channels on here. Let's see if that wave 4, 1, off of 3, off of 2, wave 4, perfect. So then Elliott channel, I like my twofold field. Let's see. Now the 5th wave does not have to reach the end of the channel. It doesn't have to. Let me do it off of 1, 3, and 4. Do it off of 1, 3, 4. No, even still, it doesn't have to. But that looks like 5 waves. All right. So put you here. Now we're gonna work with, what is this? Yeah. Correction P, wave 4. This is C1 still in progress. Okay. So daily chart, looking at here, we're gonna call this off the low. Okay, off this low, because we're probably gonna have different counts. This looks like what the oil market kind of did on the hourly time frame. But what this looks like at first glance is 1, 2, 1, 2, 3, 4, or wait a minute, maybe 1, 2, 1, 2, 3, 4, 3, 4, and then now we're in an extended 5th wave. That could be, because then this looks like it breaks down into 1, 2, maybe 3, 4, and 5. Maybe something like that. If this was a B wave, well, let's just go ahead and break this down. Okay. This might be, we can say minor degree 1 and 2, minute 1 and 2, minute 3 and, let's go 4 hour. Okay. Let's look at this in time. So internally, coming off the low, this looks like maybe 1, 2, 3, 4, 5 for an expanding diagonal. The reason why I say expanding diagonal is because the 4 does come into the territory of wave 2, or it breaches the high of wave 1. And if that happens, in order for this to still be a valid impulse, that would mean 3 has to be longer than 1, but 5 has to be longer than 3. And so how we measure that is we measure the length of wave 1, projected off the bottom of wave 2. And so wave 3 is longer than 1 because it breaches and passes the 100% projection. All right. So then we also want to see wave 5 be longer than wave 3. All right. So we take the length of wave 3, projected off of the potential wave 4, and we do see that wave 5 does pass the 100% projection. So that could be a valid wave 1, expanding diagonal. So we'll put our trend lines on here, and we would like to see the trend lines diverge, but we're not going to get that here. We want to see the trend line. See, yeah, these are converging. They're going in. What we want to see is something like this. We want to see like a trend line. Oh yeah. For an expanding diagonal, we want the trend line to widen, right? Like an alligator mouth. Contracting diagonal, different parameters, but you know, that's not a hard fast rule. It's a guideline. So for the time being, we're going to label this a 1, 2, 3, 4, 5. So I think that would be minor. This would be minor degree wave 1, minor degree wave 1. And this would be minor degree wave 2 down here. This looks like it would be minute degree 1 and 2 for 3, 4 over here. And then this would be minute 1 and 2. I think this is minute 3 and 4. I'm gonna put it here for right now, but we'll figure it out here in just a second. Off the low. What date was that? 6/29/26. All right. So this is what I want to do. We're gonna label this minute degree 1, 2, 3, 4, and 5. All right. Go up on hourly chart. And then this looks like a WXY 5, 3, 5 or a zigzag with an X, and then a 5, 3, 5 for another zigzag. So that's going to be a minute degree WXY. WX and then Y. And then the W, this zigzag is an ABC, and then this zigzag is an ABC. That will be at a minuet degree. Minuet, A, B, and C. I want you on day, put you on out. Same thing right here. A, B, and C. That's that up. Now I could go and label this a 1, 2, 3, 4, 5. I ain't gonna do that. Not because just because I don't need to right now. Let's see. Go ahead, put you on here. The W. Then I'm gonna just put you there. Then put the 2 there. Right. So right here for this minute degree wave 1, I think we can squeeze 5 waves out of that. Yeah. 1, 2, 3, 4, and 5. Or you can say 1, 2, 1, 2, 3, 4, 3, 4, 5. That's what that looks like. And that's going to be a minuet degree. So let's keep it simple. We're going to say this is 1, 2. I like this. This one is 3 and 4, sticking with the 5th wave, extended 5th wave. We're going to be on hours. And then we have real nice ABC, real nice zigzag for wave 2. What we want to see. AU. Oh, it's supposed to be minuet. I'm sorry. Supposed to be minuet. Put that on hours. All right. So then now coming into this, what is this? That looked like a real nice wave forward. That looked like another expanding flat. So is that this degree? Is that minute degree or is it minor degree? So we have a 1, 2, 1, 2. This could be another 1, 2. That would be at minuet degree. So if this is 1, 2, then this will be 3, 4, 5. I think that's what that is. So then this would be minuet. You know, we did that. I don't know. I'm gonna snap it there for now. We're gonna dig into this right now. We're gonna go down to the 1 hour. So is this 1 and then all of this is 2? That is lower than that. All of that is 2, or is this like a something 1, 2, and then this is 3, and then this is 4, and this is 5, and then this is 2? So the reason why I'm going through and looking at the past, because all of the price action in the past is going to have an enormous effect on what price action is in the future. This is how we're going to be able to get some good support resistance, some good entries, some great stops, and ultimately some spot on targets. I think this is 1. I'm going to just call this 1, just a straight impulse wave up. All right, July 29th. July 30 was an important day. I think that's when the market turned as well, turned to go up. So we had 1, 2, 3, 4 hours straight up. I'm gonna call that 1. I'm gonna call that minuet degree wave 1. Maybe if I go down to the 30-minute, I'm gonna go down to the 10-minute. Let's see what happens there. See if we can pick out 5-way. Yeah, we can. Oh yeah, yeah, we can. Yeah, that's perfect. That looks like a 1, 2, 1, 2. Let me do it right here. It looks like a 1, 2, 1, 2, 3, 4, 3. Again, like that. You got a 1, 2, 1, 2, 3, 4, 3, 4, 5. Wave 1. So then all of that is 2. All of this is 2. This is a A, B, C for A. Then we had a, so I guess we can call this an expanding flat. That's what that looks like. A, B, does this break down the 5-way? I can do that. I can say this is 1, 2. So this is A, B, and then the C wave should break down into 5. 1, 2, 3, 4, and then 5. Yep. And then, yeah, 5th wave breaks down into an expanding diagonal. Yeah, 1 and 3. Yeah, so this is one I was saying where the expanding diagonal has to have uh, diverging trend line. So that's what we're getting ready to do. All right. What did I say? So then this is going to be at, it's going to be something anyway. It's going to be A, B, and then C. And just for something anyway, it needs to be on hours. Just for shits and giggles, we're going to go ahead and say that's A, B, C for A. That's a zigzag, right? And then your B wave, that's a zigzag. 1, 2, 3, 4, 5, B, and then another impulse wave up. I'm just gonna label that B. Instead of breaking that down, but I do want to break this one down. And that's that 5 waves at micro. It looks like we got a, no, that looks like 3. That's a, no, that's gonna be a WXY. So I can say this is a 3, 3, or an X maybe. 1, 2, 1, 2, 3, 4, 3, 4, 5 for a W, X, and then a Y. 1, 2, 3. This looks like a flat, a 3, 3, 5 with an X in the middle, and then another 3, 3, and then another 5. So that's what we're gonna do. We're gonna just label that a WXY at micro. WXY. To complete that wave too. All right. We'll put all this in. All right, so heading up. So if that was the low of the minuet wave two. So right here, this is a net. Oh, this is a nest again. A 1, 2. Let me go back to the. I'm gonna go to the hourly. So we have a nest, right? Building of an extension. We got a 1, 2, 1, 2, 1, 2. So now we need to have a 3, 4, 3, 4, 3, 4, taking us higher. So we're going to start with the minuet 1 and 2. Excuse me. So I need to find 5 waves out of that. And that's exactly what I see. 1, 2, let's say 3, 4, and 5 makes 1 and 2. Or is that a 1, 2, 1, 2, 3, 4, 3, 4, 5? Subminuet. Subminuet. Yeah. I'm gonna say that's subminuet 1. Actually, I'm gonna say this is subminuet 1. Oops. Record. Subminuet 2. And then that looks like micro degree 1 and 2. So that's micro 1 and 2, micro 3 and 4, subminuet 3 and 4, then 5 to complete your 3. What I do? Oh, I moved the wrong 4. Okay. So minuet 4, and then I think this should be your minuet 4 is done. It's on the hour. Your minuet 4. Then we're looking for minuet 5. And that looks like 5 waves right there. It looks like we on track. We on track. This is gonna be sub minuet. 1, 2, 3, 4, 5. Sub minuet. 1, 2, 3, 4, and 5. All right. So then we have an ABC. So now we're completing the minute degree, 4th wave, and that looks like another running flat. I mean, expanded flat. A, B, C. So this is also being able to break down the charts. You'll also learn the wave personality or the personality of the market that you're looking at. And what we're seeing so far, right, just in working on this impulsive move up, we're getting a lot of expanding flats in the 4th wave, right? So I do want to just for a brief second go back to the weekly chart. So I'm not saying that this is, I mean, right now today, just off just this one little impulse wave that we're looking at. But once you learn the wave personality of that market that you're trading, and if we are seeing over and over again on multiple different time frames that in the 4th wave we tend to have expanding flats in the 4th wave. So what does that mean? If we look on the weekly chart, we're in the 4th wave, right? So what we might see on a larger degree, we might see the same type of expanding flat on the weekly chart, right? And then this is an impulsive move coming up for the B wave, but this could end up being a double zig. I mean, being a zigzag for the D wave, for the B wave. And the trick where people get tricked out at is a zigzag, especially at this high of a degree, can internally look like a 5 wave pattern because in that C wave, you'll get another bigger correction, not bigger correction, but bigger than all of the sub waves, right? You'll get another correction in here before heading higher, which when you look at it on a higher time frame, it may look like a 1, 2, 3, 4, 5. Just something to be aware of. All right, so let's drop back down. Oh, I want to do this quick. Something I don't need to see on there. 2, yeah, I'm cool with that. The daily chart. Okay, so now we're gonna go back to the hourly chart where we were. Okay, so we got us all the way up here. Okay, so again, expanding flat. So let's go ahead and put that in. That's gonna be at minuet degree. Be your A. This is gonna be your B, and this is going to be your C. All right, minuet. You keep that on like, the daily chart. I'll take it off. All right, so we're coming to the end. We're coming to the end. So now we're looking for 5 waves up. It may already be there. This could be, this could be 1, 2, 3, 4, and now 5. That 4 doesn't cross back into the territory of 1. Uh, I can see 5 waves in here. I can see 5 in here. This looks like a leading diagonal for your wave 1 with a real decent zigzag for your wave 2. In this wave 3, I can see a smaller 5 waves in wave 3. For that 4, I can see a 3-wave correction. And again, 5, I see 5 in here. All right, so let's mark it up. So we're looking for the completion of your, excuse me, of your minute degree 5. So now we need to go to minuet and we'll throw these on here right now, and then we're gonna measure. We're gonna measure to make sure. All right, so we're gonna measure the length of 1. Let's see where 3 ends at. It ends right after 1618. So we have an extended wave 3. So then if we take the same length of wave 1 and project it off of 4, we're looking for the 100. It's extended past the 100. So now what I'm gonna do, I'm gonna put measure the length of 1 and 3 projected off of 4. We're at the 618 and we're pushing a little past it. Let's look at RSI. Well, we got divergence here at the 1 hour. Let me see what the 4 hour look like. If that's 3 and 5, there's no divergence on the 4 hour. No divergence on the 4 hour. Definitely not on the daily. Let me go back to the 1 hour. We got some divergence. So I'm at the 1 hour. There's 3. There is some divergence there. Here's this 3 compared to this 5. There's, yeah, I can call that on the hourly stochastics. Uh, with the 5, we do have some divergence on the 5. The MACD, we have divergence. So 3 out of the 5, 3 out of 3, this does look like a pivot as far as on the chart. So yeah, today we're gonna label this as the 5th wave is over. Or we could get, depending on, this could be a 3-4, 3-4, and then maybe one more move up. If this does go higher, then this could be a 1-2-1-2, but I really don't think so just yet. So we're gonna stick with what we got. And ABC. And I am going to label those internal waves at some minuet degree. That looks like, oh, I said this looks like a leading diagonal. 1, 2, 3, 4, 5. And they break down into zigzags. This looks like a uh, contracting where 1 and 3 the trend line relative to the 2 and 4 trend lines should converge. Yeah, because this one is 4. This is 4 right here. Because we're going to need to pull out zigzags in between each impulsive wave. So let me just label it, and then we'll pull out the zigzag. So this is going to be sub-minuet. Yeah. Uh, you could even go, this is wave 1, wave 2, wave 3, 4, and 5. Or 1, 2, and then you have your zigzag, 3, 4, and then you have your zigzag, 5. Yeah, that's what we're going to do. So 1 and 2, and then this is 3 and 4, and then this is 5. And you have your diverging trend line. I mean, converging trend line. Yep. So then that gives us wave 1. Then this is the ABC for 2. That's a minuet degree. That's A, B, C. And then we got lock 2 in right there. And then we have another 5 waves. So what? What I do want to show is this. The leading diagonal, each wave, each impulse wave has to subdivide into a zigzag, A, B, C, right? You got an A, B, C for your wave 2, and then this is A, B, C for your wave 3, and your wave 4 down. If I broke it down into the 30-minute, we'll probably see a zigzag, and then for your 5th wave, there's another A, B, C. All right. So right here for this 4th wave, we got another A, B, C, a 3-wave correction. Don't worry about that right now. And then now the 5th wave, up 1, 2, 1, 2, 3, 4, 3, 4. I think we do have one more little push up because that looks like it's getting longer than a tooth though, compared to the 5th wave. 1, 2, maybe another 1, 2. Then we have 3, 4, then maybe 3, 4, and then 5. What we could see in the market is at the open, price moves up, rejects, and then comes down. Because now we're going to be in a larger degree wave 4, so it's going to be choppy. Label this something what I'm gonna just say 1, 2. Excuse me. For right now, we're gonna call this 3 and 4, and then 5. Do want to go down to the 30-minute. Let me take this off. All right, I'm gonna go down to the 10-minute. I want to see every little move. All right, 10-minute. 1, 2, 3, 4, 5. Yes, 1, 2, 3 waves right there. Then this is 1 and 2, 2, 2, 1, 2, 3, 4, 3, 4, 3, and 4. Look at that. Look how that falls. That's 3 waves, or do we call that one? One. Well, this is the 10-minute. So 1, 2, 3. That's what that looks like. 5 may be over. 5 might be over. I'm gonna leave it over here off to the side right now. All right, leave it off to the side for right now. But I think it's over. So let's look at this as if it is over. Then that would mean your minor degree wave 3 is over. And then now we should be at minor degree wave 4. Let's check this. Let's see if this looks right. So 1 and 2, minor degree wave 3 and 4. So what we're gonna do now is we're gonna measure. And we're gonna draw our channels, but I don't have them. Let me get me my base channel. Base channel is for your original wave 1 and 2. And then what you want to see for a third wave, you want to see that third wave break out from the base channel. Okay. Break out from the base channel to signify that you are in a third wave, right? Once we got the break. And then now a lot of times your fourth wave can come back to test that base channel. But we also can throw another channel on here, a wave 4 channel, where we can go top of wave 1, up of the top of wave 3, and copy off of the end of wave 2. And then a lot of times your fourth wave will come touch this trend line. So this is what I want to do, like that. Where's my, oh, yeah, I want to turn that thickness down. 0 and 1. Let's see. Save as wave 4. Yes. Take this. I'm gonna leave that on these. So what I do want to do is pull this out just a little bit. Off the low. Okay, yeah, we're right. Off the low. Then this one will be off the low, channels, and forks. Ooh, I ain't even pulled the pitchforks out yet. All right. So we could be seeing the fourth wave come down here, maybe. But then let's say now we can pull our retracement out, and then we can measure the length of the third wave. Make sure that's on there. Nope, it's not. So this one's on there. There it is. All right. So we can measure the length of the third wave, and for your fourth wave, we have a zone anywhere between the 14% retracement down to the 382. Look at that. 382 crosses right over the bottom channel trend line. Uh, this is September. So what this means is that this wave four will give us a B, and a C. Let's look at this on the daily chart. So daily chart, okay, don't look that far away like it did on the hourly chart, but we could see some type of, you know, 335, or actually it looks something like this, and maybe move up and then 5 waves down. We could see something like that. 1, 2, 3, 4, 5. Yeah. So let's off the low fields. Off the low. Yeah. So I'm gonna leave that wave for retracement on here. I'm gonna leave the base channel. If I want to. I mean, oh, let's do this. Let's measure the time. So we're gonna go we're gonna measure the time of the wave two. Call this correction. Let's call it correction. And I'm gonna copy this, and then we can do that. Damn, that puts you right there too. So we may push past as far as time because your wave fours, well, this wave two, I'm gonna call this one a sharp. That's a sharp correction. And so what that means is with the rule, the guideline of alternation is you should have, if your wave two is a sharp, which they typically are, your fourth wave should be a flat, or we should expect some type of flat pattern, right? Which would mean whatever retracement we get, we'll get a first pullback, and then we're going to get a retracement that's going to take us back up near the highs or even past it. And then the third wave or the C wave will come back down. So we can get an A, we can get a B. Now, if you remember when we looked internally, in the wave structure, we saw a lot of expanding flats, right? The B wave is the sucker wave. It's gonna suck you in. Yeah, it's gonna make you think you're breaking out, and then it's gonna pull the rug out from up under you. Always and forever. And then when it pulls the rug out from up under you, and then when you see that move down, now what you're gonna start thinking? You're gonna start thinking that we're in a downtrend. And as soon as you start going short on that bounce, or even, you know, yeah, on that bounce, then it's going to rip you a new one. That's just what it does. All right. So this is the bullish outlook. Well, not the outlook, but in the present form where we're at right now, put you right there. Put you right there. So then this 5 can go over here. Now, again, looking at it on a larger time frame, We're putting in a decent 5-wave pattern, right? So I am expecting for a pullback and then another move higher, right? But then that could just be your A wave up. Then we're going to get a B wave back, right? And then I'm expecting maybe for another A wave up. But first, let's let this play out. Let's let this play out. We can still take advantage of the upside. I would not be trying to short, even though we can probably get some good shorts. Let's say this. I'll first say we need to let the A wave and the B wave play out, right? And then you can probably short the C wave down. But especially considering the volatility now, we go back to what the market is doing, what the Treasury Department is doing. There's a lot of eyeballs on it. It's a lot of volume, volatility. People are trading in and out. It's a lot going on. So this is not happening in a vacuum. So I'm saying all that to say we may want to leave the correction alone unless you're scalping on the 1 hour chart. You're taking some little moves like right here. So if we're looking at the 1 hour chart, if we're looking at the 1 hour chart, with this move down, maybe a bounce up to a good Fibonacci number or something can lead you to a short back down. But I would take profits quickly. Maybe once it reaches, you know, the next low, be out, and then let it play out. Even if it does stretch, don't feel like you're being left out. Just let the pattern play, right? Let it form, right? Then let it give you another correction. Okay. But a correction back up before shortening back again. Um, Again, if this is going to be the way for, look, we got about 13 days. Okay. If this is a minor degree wave four, this could be 2 weeks before it actually resolves itself. And in 2 weeks, again, we can get down, up, down. It could be all kind of stuff. Now we could get a wave down and then a B wave forms where it's looking like an impulse, but it ends up really being a zigzag. You can still get good trades. So we got to take it on a case by case basis with the larger context in mind that this most likely is a wave four, right? It's a corrective phase, so it's going to be choppy. Going to be choppy. We got retracements. Where's mine? We got retracements. We got time and price. We got time and price. Let's work on timing again. So if this is a wave three, this is wave three. Call it impulse correction. Let's see. Let me go back. I think I did that one. Hold on. Where did this one go? This one ain't even at the low. Okay. So wave two was actually a little longer. Go back. So wave two was actually 14 days. So 14 days. So it was actually 14 days. Okay. So now I'm looking at this, the full impulse move of wave 3. And here's the yeah, 382. It is. I don't want 382. So here's a 50% time extension, 618 time extension, 100% time extension of wave 1. I would be looking for something more around the 50 and the 618. Here is the time length for wave 2. Wave 2 took 16 days. The fourth wave usually would be longer, especially if it is a flat. Let me change that to a flat. Especially if it is a flat, right? So we're looking for it to be longer than 16 days. So that would push you out here. Here are trend line. Yeah, it could be in a correction for a few weeks. I will leave that on here though. Correction time. And then I'm gonna say did I do that? Oh, it's below it, not in there. I'm gonna put it in there with it with that. Um, let's see, broader context of this whole correction. Let's look for some support resistance. So, well, for back to time, we're looking at anywhere from September 7th, September 9th to September 13th for the correction to be over. September is an important month. I got a lot of different stock, a lot of different oil. Middle to end of September, I mean, we could see some fireworks. Let me see, October, November, December. Yeah, because that leads you into the end of the quarter, end of the third quarter, start of the fourth quarter. Right, the elections coming up in the fourth quarter. September, October, the end of the year is going to be exciting, as you know, or whatever definition you want to put on exciting. It can be good or bad. Um, but nonetheless, let's look for some support resistance. Do we have any gap? Let me go to the daily chart because we still have to deal with this. So we got pivots, we got major and minor pivots. So minor pivot, we got a major pivot. No, that's still gonna be a minor pivot. Let's flag it with some prices. Which way I want to go. I'm gonna press that. I'm gonna move it over here. And that's 47, 73, 58. 47, 73, 58. I'm gonna copy. And then this one is 48, 90, 96, 48, 90, and 96. And then even higher, we have 54, 19, 32. 54, 19, 32. And this is going to be support resistance. SNR. So that's going to be, we can call it resistance. I'm gonna call it pivots. Same difference. Here's another one. Look like we just cleared it. So we may end up falling back below it. And then, oops, this one is uh, 45, 95, 35, 45, 95, 35. Important resistance. We'll be down there. I'm gonna lock it. And we'll be, oh, got copied somehow. Oh, all right. Anyway, so we got those numbers. Do we have any dojis? We got one right there. Might be able to call that one a doji too. Open 45.21.91. Close at 45.18. I'm gonna put it on the daily doji. Put it on the. I won't put it on. I'm gonna put it on the open. This is gonna be key numbers and yeah, I should have moved those in there. Any more up here? There's one. That's a beautiful one right there. Right there, right above that minor pivot. There's one. Do we have any gaps? Don't look like we have any gaps. Key numbers. I also have, which is kind of irrelevant. It's not irrelevant, but uh, where's the midpoint of that initial drop? Um, what am I looking for? Oh, impulse range. So the midpoint of this initial drop is right here, right above the minor pivot. I'm gonna put resist. I'm gonna just call that resistance right there, right on that same doji. Actually, gonna change that name, and then I'm gonna say this is impulse range midpoint. Impulse range midpoint. I'm gonna turn it white. So the impulse range midpoint is right there. That could be where the B wave ends. I don't know. I'm gonna delete this though, and this goes in support and resistance. So I'm gonna hide this one because we only really need to move correction time down here. Correction. Move correction time down there. I'm gonna take the base channel off. Take the base channel off. We might see at this 100%, we might see that be where the B wave ends, maybe. I don't know. But let's do a retracement of this whole move down. And we're going to do the golden zone. So there's the golden zone retracement right in here. There's a lot of a lot of landmines ahead. A lot of them, to where it could be hard getting through here. But this is where we could see a reversal back down as well. So we can go 1, 2, 3, 4, 5 in the zone, and then that could be where the bears step back in and push it back down. So that's why we have to be cautious. That's why we need to know everything that happens to the left to get a gauge of what's going to happen to the right. So we got a zone right here that you probably want maybe stay. I'm gonna just say today, maybe stay out of it, because it could get hairy, because this is where they're gonna be fighting. This is where they're stepping up. This is, if you think about it as a football field, right? Right. That's right in the middle of that football field. Okay. I think I'm gonna leave it at that for right now. We're waiting on a correction, right? We're waiting to see what happens um, in the next day or two. In the next day or two, my RSI bars are showing me. Yeah, this could be it. 1, that's 3, and then 5. Yeah, the RSI bars turn blue, and then they turn blue when they get to the oversold, overbought limit. And then when you get your change of color back to normal, that means that we're back up under the oversold, overbought, which signals a correction, right? Like we did right here, blue, 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 wave 3, turn back to normal, dipped up under the overbought, correction. Blue, 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 change colors, correction. Something wrong with my volume profile. So I'm gonna leave it at that for right now. All right.